Good morning, good afternoon, good evening, wherever you are in the world. My name is Hugh Morris. I'm a senior research partner with the Zien Group, and it's my absolute pleasure to chair today a topic on which I think people will have an exceptionally high level of interest, the role of central bank digital currencies. And we're very lucky to have Dr. Michael Lloyd, Senior Research Fellow and Associate Director of the Global Policy Institute, to explore this subject with us. Now, we couldn't do anything at Zien in terms of this series of webinars without our sponsors, which you can see on the screen there. And thank you very much indeed to our sponsors to enable us to range far and wide and present diverse subjects on webinars, which we know people value, both on the direct attendance and on the views on YouTube. And so the structure of today's session will be very similar to others that, I will get out of the way very quickly. Michael will then share some thoughts with you for 20-25 minutes, and we'll then have the Q&A session for 20-25 minutes thereafter. Please post your questions on the chat facility, and I will be delighted to relay those to Michael. So without further ado, I will hand over to Michael.
Thank you, Hugh, and thank you for the introduction. And good morning, or good afternoon, or good evening to everybody who's watching. I'm going to talk about the international dimension of CBDCs, central bank digital currencies. But the first couple of slides, I want to look at really what we mean by central bank digital currencies, and really what we mean by money, and particularly the distinction between private money channels and public money channels, which is at the heart of the issues raised by central bank digital currencies. So if we look at public and private money, money is often described as a medium of exchange, a store of value, and in passing, the unit of account. But the unit of account is critical. Money is used as a medium of exchange and store of value, rests essentially on the notion of a unit of account. And a unit of account is an intangible numeraire, a measure for commodity valuation. No other commodity will do. This is one of the problems when we use gold. You are measuring the value of other currencies via a commodity. Nowadays, we don't do that. And in fact, fiat money, private fiat money, is accepted in monetary jurisdictions. And the key reason for that is that 95% of the money in the UK, for instance, and elsewhere, is actually printed effectively by commercial banks. But that money is guaranteed by the central bank so that you can have trust, public trust, universal public trust in that money, in that fiat money. And the whole monetary system within jurisdictions and between jurisdictions rests on that universal public trust. That's not to say that occasionally central banks themselves come into question in some countries, but generally speaking, that's the way the system works, and you need central banks and you need that universal public trust. The problem that we've had recently, in recent times, is new private digital money channels. And this is a problem for that universal public trust within and across monetary jurisdictions. Next slide, please. And concerns in particular of central banks about global financial stability, I'll say that again, global financial stability from the increasing use of digitized private money channels has posed a problem for central banks, and the Bank of International Settlements has produced many papers on this issue. Stability is an important public good, and we must never forget that. I mean, recent events in the States have shown that financial stability may trump price stability if there's a rocky patch for any individual financial institution. But current cross-border financial transfers are inefficient. They suffer from high costs and low speed. And you can improve that via digitization. And this is really what the private sector, in terms of developing private digital currencies and private money channels, has been able to do. But this was presented an opportunity for central bank digital currencies. And central bank digital currencies have benefited from the development of digital ledger technology. The essence of those, as far as central banks are concerned, is to ensure that you have a synchronous shared ledger. That's the only thing that's required. You do not necessarily need blockchain. I'm not really going to talk about the technological elements, but most of the projects, which we'll come on to soon, rest on digital ledger technology, not specifically blockchain. I'm not saying blockchain isn't useful, incidentally, but central banks don't need it. Next slide, please. And these concerns for central banks have led to a variety, multiplicity of international projects involving central banks and commercial banks, testing, and other financial institutions for that matter, testing what is called wholesale CBDC financial transfers. And the Bank of International Settlements has been involved in a number of those, and in particular its M-Bridge project, which includes China, incidentally, is aimed to develop a prototype for wholesale CBDC cross-border financial transfers of all kinds. You can look at the various projects. I mentioned 4 of them. There's Project Jura, Project Dunbar, Project Helvetia, and recently and interestingly, Project Icebreaker. An Icebreaker actually uses retail CBDCs in a very clever way, a hub-spoke system. But so it's worth looking at Icebreaker. Last week, it produced its report on the pilot project. It's well worth looking at that. And the results of all these projects are definitely promising. Next slide, please. And the projects are regional but extensive. They cover not just the small region, but the banks involved, the central banks involved, and the commercial banks involved, go across countries and across regions. So they are quite extensive. And it indicates the potential to expand across a variety of monetary jurisdictions. I will come back to that particular issue later. The first digital currency project was, of course, initiated by China in 2014, the Digital Yuan, now termed the ECNY. And certainly when it was launched, or even before it was launched, the idea was very much to use the Digital Yuan in a broader trade context, not just within China, but cross-border. Again, I'll come back to that at the end of this presentation. And obviously the ECB is also considering central bank digital currencies and looking at cross-border transfer as well. And of course, although people know about the euro area, what they don't always recognize is the single European payments area, which covers 36 countries, including the UK. But of course, in terms of cross-border in transfers in this manner, interoperability is required. Now that's a technological issue, and there are lots of technology companies working on interoperability. But you will also need, and again, there is work starting on that, international standards for CBDCs. Next slide, please. Now, actually, these cross-border projects and cross-border, they will turn into actuality within the next few years. We will see cross-border CBDCs operating in terms of financial transfers, and not just payments, securities transfers, etc. But they're being launched into what is a fragile global financial situation and context. And those threats to stability have been concerned for some time now to the Bank of International Settlements and to the IMF. In fact, if you look at the global reserve situation, some interesting statistics there that IMF special reserves accounted for 90%, SDRs accounted for 90% of global reserves in 2007. In 2021, they were down to 25%. Now that was largely due to the global financial crisis and the post-financial crisis. And the shift has been towards regional reserves, which represent about 30% of the total, and currency swaps. And the majority of the currency, or sometimes called credit swaps, involve the US Federal Reserve. And in fact, post-2008, the US Federal Reserve has been acting as a global central bank via there is so-called C6. There are 6 central banks, including the Federal Reserve, the Bank of England, Swiss Bank, ECB, Bank of Canada, Bank of Japan, but also temporary swap arrangements and credit arrangements with 14 other central banks. And this has kept the system more stable than it would otherwise have been. So in a sense, we owe that to the Federal Central Bank. But if we can move to the next slide. What one notices if you look at the system, particularly in terms of the US, people often talk about a multipolar world. We don't have a multipolar world, certainly not in monetary terms. The global US dollar zone system is what keeps the global monetary system in being and not falling apart. Now, 40% of global trade is invoiced in dollars. And despite the fact that the US only has 10% of the US share, figures for China are 15% share of trade, but only 2% of that trade is invoiced in one, whether digital or not. 80% of publicly traded debt is dollar denominated, and 60% of international currency reserves are denominated in dollars. Now, this monetary dominance, this current monetary dominance by the US is patently necessary. The system would collapse without it. We have monetary anarchy, but it is not necessarily satisfactory. It's not necessarily a satisfactory way of proceeding in the long run. Again, I'll return to that towards the end of the presentation. Next slide, please. Now, in terms of digital central bank currency areas, using that in terms of cross-border transfers, it is possible that smaller jurisdictions may try to adopt CBDCs. Yeah, it's fashionable. countries, economies, monetary jurisdictions will think, oh, well, okay, we can create our own currency. That could create considerable problems unless those jurisdictions, those economies, have clear and stable fiscal and monetary policy regimes. And a number of them won't have those. And the ones that are likely to go for a CBDC may well be the ones that don't have those regimes in place. Now, as I mentioned earlier, not only is the monetary reserve situation being extensively regionalized, but so is international trade. I mean, it's always been the case that trade with your contiguous regional countries has been the main driver of trade, and the main element of trade is with your own close regional partners. But nevertheless, it is that regionalization of trade is becoming much more extensive, particularly in Southeast Asia and Asia more broadly, but also, of course, in terms of the European Union and the Euro area and the Single European Payments Area. Now, there is, once we have digital currency areas, there's a possibility of quite large DCAs being formed. The potential for DCAs for China, I mentioned that even before the digital one was actually saw the light of day, the idea in China was that the digital currency area could be used for trade. In fact, they were talking about Hong Kong, South Korea, China, even Japan. There's less talk of that now, but the potential for large digital currencies being formed is still there. And of course, the potential for those for China still, for the EU, including the Single European Payments Area, and the US, in terms of the dollar area, could lead to a more balanced global trade invoicing structure. Next slide, please. Is there a possibility, therefore, of the replacement of the global US dollar zone system, which, as I said, is the dominant global structure at the moment? At least we have a structure. Now, the advent of large digital currency areas is likely only to lead to changes in the invoicing of trade. So there is likely to see an expansion of the invoicing of trade in the yuan, probably at the expense of the US dollar and to an extent the euro. Now, such a change would not, in fact, spell any significant challenge to the monetary dominance exerted by the US dollar zone at the moment. However, large DCAs may be a precursor to the eventual replacement of the US dollar as a reserve currency and as a unit of account. Next slide. So we'll move on, in fact, to the final slide that I'm going to flag up today. So what is the possibility? Is there a possibility? Is it desirable? Will it happen? When will it happen? Clearly, with a smaller number of large digital currency areas, based on the euro, on the dollar, and on the yuan, it should be easier to get agreement to move to a system which is not reliant on one particular country. And it doesn't matter whether that country is the US or China. It is not, in the long term, a sustainable position. I mean, already, if you think about the Federal Reserve of the US as a global central bank, there's a problem. Okay, as a global central bank, it has certain motivations and certain necessary actions it needs to take, but also it has to look to the US. I mean, it's the US central bank, and therefore there may well be, and is to an extent, a conflict of objectives there. So there is a need for an independent global unit of account, but that would have to be accompanied by a global clearance and settlement system and a global central bank that was independent of any country or any monetary jurisdiction. The Bank of International Settlements could be such a bank. It has been suggested before. Of course, Maynard Keynes in 1944 raised this issue with the idea of a bancor as a global unit of account. The problem was that that would involve, if that had come about, and if any global unit of account materializes, that monetary jurisdictions would be surrendering control of monetary policy. Because you need to accept, as you do within individual monetary jurisdictions, the idea of a global clearance and settlement system, final settlement system. That's what we have in the UK, in the US, in the Euro area, an acceptance of that clearance and final settlement system via the central bank. Now, there are two barriers to this. I mean, let me declare an interest. I've always been in favor of a global central bank. I was brought up, and my experience at Cambridge reading economics was very much in the Keynesian tradition. So not surprisingly, I'm in favor of an independent central bank and an independent global unit of account. So the two barriers are, first of all, the one that was really recognized by Keynes and by others in 1944, Bretton Woods, is that you do need this ability of, or rather willingness of nation states to surrender their monetary sovereignty. That's not going to be easy. Moreover, you now have US political hegemony linked to its monetary dominance, and that also may well be a barrier to reach any agreement. But when I talk about the potential for a global reserve currency and unit of account, we're talking decades. I mean, it's been almost 80 years since Keynes put that idea forward. Will we wait another 80 years? Well, I won't be around to, to see it if it came about in 80 years and even a shorter time scale. We're decades away. But I think the advent of central bank digital currencies and its changes to the invoicing of trade does move us to a position where at least some discussion of this should be taking place. Hence my presentation today. Thank you.
Michael, thank you very much indeed. What a fascinating exposition on a fascinating area. We've got some great questions coming in, and please do keep them coming. If I may, I'll start off with a question from Dan Bahini, who is saying, hasn't the weaponization of the dollar with sanctions against Iran, against Russia, etc., accelerated the de-dollarization agenda and increased monetary instability?
They definitely increased monetary instability. That's absolutely true. And therefore, I think, although I think there's no international discussion of moving to an independent reserve currency, I think the fragility of the system that has been exposed really makes people think, and should make people think, about whether or not we can actually move to a more rational system.
And a question from Shrikant Taniru, let me get it right. I think going back to your earlier point about we need a shared ledger, not necessarily a blockchain ledger. And his question is, wouldn't we need a distributed ledger technology architecture if we want multiple validators to settle the payments of the central bank digital currency users?
Yeah, I think the issue is that most of the work that's been going on in terms of projects have involved a limited number of commercial banks and other financial institutions. Now, if you have a limited number, then trust is assured. You don't need, therefore, to go beyond a shared synchronous ledger. Now, I suspect for major financial transfers, that will be the case. Now, for ordinary transfers, I mentioned the icebreaker, which is looking at how you might operate with cross-border payments with retail currencies. And what that uses is a bridge currency. It's a hub and spoke system with a bridge currency. They happen to choose the Norwegian kroner because Norway was one of the participants in the in the project. Now you could argue that Ripple has its own bridge currency. So private sector is experimenting all the time on this. So yeah, I think the restriction that I mentioned, avoiding necessity for blockchain, is simply because of the size of the participants and the fact that their trust is validated before they enter the system and become a node on the system.
Stephen Greenfield's comments, thanks, Michael, fascinating talk. And he then asks, are there any practical lessons for central bank digital currencies arising from A, existing cryptocurrencies, and B, the El Salvador Bitcoin experiment?
No, it's short answer. Sure. Well, I mean, no, in the sense of any direct emulation, is clearly not going to happen. One of the problems with Bitcoin, for instance, and most crypto assets, I mean, they're crypto assets rather than currencies. I know Bitcoin started off with the possibility of being a currency, and because it's split into satoshis, then it can be used in that way. But what people forget is that the trust is purely internalized within the blockchain, and interaction with the world outside the blockchain and outside the partners within the blockchain is, that trust doesn't exist, and that's the problem. The whole point about money, as I mentioned in my first slide, is it's about universal trust. And that trust is going to be tested when the public is asked to look at digital currencies, because the problem is a pound note or a coin or a dollar, a greenback, is actually a physical, tangible object. Digital currencies aren't tangible. They are equivalent to a fiat currency. They're not exactly the same, because clearly you have to have some cryptographic mechanism preventing them being used again and again. I mean, obviously with a banknote, it is used again and again until it wears out. So there is that difference. So it's quite important to recognize that.
Thank you. Liz Thrussell suggests that a digital currency would still depend on the value of the US dollar.
Well, I mean, you mean well, I'm not quite sure about the question. I mean, clearly, if you have a digital dollar, central bank digital dollar, and that is being looked at in the States, although the States tends to favour the idea of stable coins, which are linked to the value of the dollar, being used in a complementary manner to central bank, central bank digital dollar. I think that may well happen, actually, and it may well happen in other jurisdictions, but you'll need tighter regulation on the issuers of stablecoins. Not the same as banks. They don't need to be as heavily regulated as banks, but they will need to be regulated. They may actually finish up as narrow banks. In other words, they won't be involved in credit creation, but they will be able to make loans, but only in relation to their deposit base. Hopefully that deposit base will not do what the Silicon Valley Bank did, which was then to buy long-term bonds and not realize that any rapid increase in interest rates by the central bank, by the Fed, was going to create a problem for them, which it did.
Indeed. Further observation from Richard Sage. If one lives in a country with a weak central bank, say Argentina or Albania or Algeria, holding US dollar banknotes has always been attractive. Central bank digital currencies enable holding the same contractual asset, but without the disadvantage of storage and conversion friction. So central bank digital currencies will be inclined to increase the dominance of the US dollar and the Swiss franc, not weaken them. They make currency controls much more difficult to apply and do not require any agreement from those weak countries, he suggests.
I think the reason I suggested that we may see the development of very large, extensive digital currency areas is because I think that is exactly what will happen. However, there is a point to be made. I mean, Cambodia, for instance, is looking at a digital currency itself, to be issued by their central bank, because they want to move away from the population's reliance on dollar, because they feel the dollar is going to be safer than their own Cambodian currency. So you'll have movements both ways in a way, but again, it will depend on, as the questioner asked, it will depend really on the fiscal and monetary regime in place, and it needs to be strong and stable for that to happen. And I think some countries are likely to experiment with central bank digital currencies, which may well fail.
Thank you very much indeed, Michael. Kenichi Araki asks, how do you anticipate with the cross-border aspect of central bank digital currencies be achieved? Would it be created on a common architecture or infrastructure, or would it be achieved by connecting multiple individual central bank digital currencies to ensure interoperability?
Yeah, it's a good question. I think the Bank of International Settlements would like to have one single system that everybody adopts. I don't think that's going to happen, which is why the issue of interoperability and also international standards is crucial in this. Certainly, I know a lot of tech companies, a friend of mine who runs one, that are looking very much at interoperability. So I think the likelihood is that we will move towards a set of interoperability standards, which will mean you won't have a single system.
Thank you very much. Anthony Kalpas asks, will central banks prefer to develop their central bank digital currency in-house, or would they prefer to work with private companies to develop the central bank digital currency along with the infrastructure necessary? If so, what would characterize the companies that are more likely to work with their central banks?
Well, actually, companies like R3, and there are various kind of systems that are being used, Quorum, etc., that are being used in these various projects. So working with the private sector, I think, is quite likely. And in fact, I think the Bank of England consultation document suggested that they will continue to work with the private sector. Having said that, the central bank, the one thing which is clear and which I don't think is mentioned enough is that because it's an issue that is flagged up in terms of privacy and concern about government spying on people, is the idea that somehow the central bank will maintain a record of all retail transactions. Central banks don't want to do that. They wouldn't. They're quite happy to maintain a record of wholesale transactions. That's the way the current system works, which is why I think, although there may be some competition, there may be some minor problem with deposits, why I think the commercial bank structure that we know of, with the backing of the central banks will probably stay in place.
Well, that leads neatly on to a second question from Dan Feeney, saying, how can the square be circled, or the circle be squared, between security, privacy and identity with respect to central bank digital currency proliferation?
I think we probably have pseudonymity, not necessarily anonymity. You won't have anonymity because of the anti-money laundering problems that the banks, the central bank and the various regulatory agencies will need to be able to intervene if they think that the law is being broken and there's a substantial amount of money laundering or other criminal activity going on. So you can't have complete anonymity. But what happens in China at the moment, in there, technically it's still a prototyping system. In China, where it's been around for a while, below a certain amount, there is no sort of, it's just done automatically. There's no record of it. It's just, you just need, it's just done on the phone. So I think there are ways by limiting by a kind of de minimis level, that below that level there's no monitoring, and also that you'll have you can know about the transaction, but you don't know about who's carrying out that transaction. That, I think, is what is likely to happen. So privacy is very important. We know that it's a key issue for the public, but there are ways of as I say, of managing that.
And I think looking a little further in the same area rather, Peter Koenig asks, Dr. Lloyd, where do you stand on the fears of central bank digital currencies being used towards big brother controls along the lines of Brave New World, etc.?
I'm not worried about it. I mean, there's a constant worry about this. It isn't just about central bank digital currencies. It's just generally, I think, the idea, for instance, that somehow Xi Jinping has some intelligent system, which means he knows exactly what every single of the 1.4 billion people in China are doing at any moment in time. No, it's nonsense. I mean, there's no way in which you can monitor that. No, it'll be monitoring by exception. I mean, I indicated just now that AML, anti-money laundering, that and criminal activity, and the security services will also be there as well, and if they feel it's necessary to intervene in it. But these will be exceptional. There's going to be no overall surveillance of the population.
Thank you very much. Michael D'Souza asks, will the implementation of central bank digital currencies eliminate money laundering, or will it lead to a parallel system developing?
It's a good point. I don't think you get rid of AML, money laundering, at all, or criminal activity. That will go on. And yes, there is a danger that the private money channels will be used to do that, and are being used to do that, I think. But I mean, apart from stablecoins, which, as I say, the stablecoin issues will be regulated, and that's been planned. I think the proliferation of crypto assets, I think, is going to be a dying breed. I think they will disappear, but you will always get private money channel used by criminals to launder money and for other purposes. You won't be able to. That won't disappear.
Thank you. Stephen Greenfields further asks, for a global unit, do you envisage a basket of leading currencies, pegging currencies, or some other mechanism?
No, I think the SDRs, for instance, which the IMF issues, are a sort of independent global reserve, or so they've diminished in their importance in the global reserve system, and they are based on a basket of currencies. And any global unit of account would have to take account of the weighting. There would be a weighting system. Yes, I think that's how I anticipate that would happen.
Tremendous. And I think we've time for probably one last question. And I think the question would be, if you were to look at the world as you project it developing in, say, 10 years' time, I mean, how embedded in both international systems and everyday lives do you think central bank digital currencies will be?
Oh, they will become embedded. I don't think there's any doubt about that. I mean, initially it will be the cross-border wholesale CBDCs, or certainly in international transactions, you will have that because of the need for financial stability and for universal trust. That will take place, and that'll take place over the next 3 to 5 years. I think beyond that, in terms of domestic currencies, it'll be a slow process, and some countries will take longer than others. I would anticipate that the developed countries within 10 years probably will have their own domestic currencies. In terms of an international global reserve currency, as I indicated, that will take a lot more decades than one to achieve that.
Dr. Lloyd, thank you so much. And I think I speak on behalf of everyone to say thank you very much indeed for such a fascinating and really topical conversation. And once again, thanks very much to our sponsors for enabling us to put this webinar on with the program. Thank you very much to the audience for both attending and for some great questions coming in. I would commend the upcoming webinars on tomorrow on Asia's Noodle Bowl of Trade, next Monday, transforming retail banking to meet evolving customer needs, on Wednesday, working upstream of crisis, and the main event of the month, I might say, second, of course, to this one, the launch of the Global Financial Centres Index 33 next Thursday. So once again, thanks to all, a particular thanks to Dr. Lloyd for such a really, really engaging session. And I wish you all a tremendous rest of the morning, afternoon, or evening, wherever you are in the world. Thank you very much indeed.
Thanks to everybody.